on this Memorial Day weekend. Thanks, guys, for joining. Uh, well, it was a fairly quiet week. Um, I think I wrote about it on Sunday. Yeah, equity went up mostly after a couple of weeks down. Nothing particularly exciting on the volatility side of things, especially when you compare to this is us now. So obviously it's going to feel very boring, very flat, uh, very predictable in some ways. Markets end up going back up without much damage. Obviously, we don't trade directionally, but it's always nice to get a picture of how things evolve, because even if you trade directionally, you end up still having to manage the put side and then obviously the call side. And I hinted at it a few times on the Discord, but in a regime like this where things are a little bit more flat and calm, and especially in US equities, right? That works for indices. More often than not, markets will go up. So even if you start the trade market neutral, you may want to skew your strongholds a little bit to be slightly positive delta, because we know we'll have a look at the vol surface in a second, but we know that more often than not the problem is on the call side, right? You have about 20 points of implied volatility in your put. You don't have as much in your calls. If you just stay market neutral and there is a bit of a drift up because it's US equities, I mean, you're gonna survive, right? Like I showed the trade of selling every stronghold or straddles in SPY over the last year in the newsletter again this week. It's widely profitable, but if you really wanted to tune out a little bit your position, you could say that, yeah, you skew your strongholds a little bit to be slightly positive delta. So 25 delta puts, maybe 15 delta calls, any variation of that is probably going to get you somewhere. This only works. It would have probably worked there, right? And it would probably work most of the time because once again, indices goes up, but that's particularly true in this kind of scenarios here. The other thing that you can do when you're here, didn't talk about it on today's newsletter, is obviously consider risk reversals. So we've had a couple of weeks of, yeah, like I mean it was not as brilliant as all month of April, early May. I think it was just 1 week where we were a little bit on the downside before last week things went back up. Um, and same idea here. You will want to be selling something like a 20-25 delta put, and then go buy 15 delta call, something like this. Most of the time you'll be paid to wait, and then once in a while you have those nice move on the way up. That works if you're trying to add positive delta into your book. I saw a few questions um, in Winthrop actually. So I know that some of you are looking for delta exposure, positive delta exposure. There's plenty of way to do it. Simplest one, obviously, you just go delta one, but I thought that mentioning those risk reversal here is a good way to remind that, like, yeah, you capture a bit of a skew premium. Your calls are not that expensive. You can do that in pretty much any expiration, although we'll have a look at this in a second. Actually, let's have a look at this now. So what I'm talking about here is obviously you still have these ones that are quite expensive in the grand scheme of things compared to that. So that's always pretty much the case, right? You have some situation where the skew between your calls here and your put is going to be much, much stronger than that. That's often the case when you have pretty much a lot of stress in the market, because when you have a lot of stress in the market, people tend to buy a lot of puts. They tend to buy a lot of options in general, but really a lot more puts and calls. So now your skew is a little bit flatter. But still, you can totally play this kind of scenarios where you sell that and then you buy that. You see, right? Like if you just like people talk about cover call and stuff like this here, you can clearly see the problem with this type of strategies, because you have pretty much negative, in some cases, you have negative VRP on your call side. So if you buy the index and then you start selling calls to um to um to monetize or generate premium, that's really a terrible value proposition, because the entire planet is doing that, and there's really no meat on the bone. If you have to do something, you probably want to be more on that side. Um, and then yeah, definitely sell the puts, buy the calls that people are excessively selling. It's not a delta neutral position, but if you're looking for positive delta exposure in your book, that's not a terrible thing to do. The temptation will be big in a situation where the market are calm, to come here, in the very short end of the curve, right? And then say, well, maybe I sell those 5 delta puts and then I see what happens. Um, Obviously, you're free to do whatever you want. It's still a market that's dominated by headlines. The headline risk is high. I talked today about, I think people need to chill out and stop looking at social media, and it's more likely that things will stay quiet than something terrible is going to happen. Um, there is some nuance in the way I'm saying this, right? Like, we look at VIX, so basically we look at this tranche here, how much volatility in option at 30 days. And we're saying, okay, well, that's about 16 and a half, whatever that was. So things are pretty much priced in. The market doesn't see anything terrible happening over the next 30 days. Therefore, if you come here and you decide to like buy a ton of options because you're convinced that the world is going to end, again, you look at it from a VRP perspective, that's not a great trade. The odds are not on your side. Eventually, if you wanted to buy options, as we said earlier, you would want to come here. That said, it doesn't mean that nothing can happen. And if you come here and if you come sell those, you have to ask yourself the question, am I well compensated for these puts? And here we have a really nice situation. That's why I'm showing this, where ironically, we know that the headline risk is high, right? We know that something can happen at some point. You're being paid 8 points of VRP at 3 days. You're being paid 15 points of VRP at 30 days. So really, once again, the temptation of data and generate premium and let's just get something quick, right? Um, it's really not great. Don't do that here. Most of the time you'll get away with it, right? Most of the time. Not on the call side. I think on the call side, most of the time you're going to suffer. But most of the time you're gonna get away with it, except the 1 or 2 times where you won't. And usually those times are painful. Now you do that in SPY, and this is where I can again bring a little bit of color and nuances. You do that in SPY on the put side, as long as you're not doing it at degenerative level of puts and your account can manage it. Yes, there are some truth to say potentially I can recover. I just wait for the put to be assigned. Now I'm long SPY, yes, whatever you guys are trading. I'm waiting a couple of days. and then I can come back at my strike. There's some merit to that. The only problem, and the reason why you will never tell me, you will never see me say, yeah, that's fine, you can do that, you're okay, is because it's always the same problem. You're gonna get comfortable here. It's gonna work for like 1, 2, 3, 4, 5, 10 days, a month, 2 months. Um, and you'll get comfortable. The premium is so slim here that instead of selling one or two contracts, you're going to start selling five, six. And it's always like this. It's when you are over leveraged and overexposed that that headline risk is manifesting itself, and you end up blowing up your account for what? Really for cents on the dollar. So it's really not a great trade. If you really have to do it, it's again like I don't like to sell tails in general unless the market is crazy. But if you really can't resist, um, don't do five. Don't do five. Come here, right? I think this is a much better trade right here. Once again, 10 delta put. But otherwise, like you don't need to be particularly creative. You can just wait for the market to be a little bit crazy on one day, and then for VRP to increase again. So yeah, you have 6, 7 points. If at some point at 30 days, so those are fixed. So let's actually look at the contract prices. If at some point you see one of those contracts going for some whatever reason at 18, 19, considering that we're below 11 in realized vol, yeah, just jump on it. 8 points VRP with realized vol starting at 11 in a contract expiring. That might be June 30th. It's going to be hard to lose money on that one. When I say it's going to be hard, it means you will need some extreme market event for realized volatility over the next 30 days to go from 11 to 18. And if for some reason Tuesday, Wednesday, whenever you even manage to sell 19, you will need something very special for us to go from 11 to 19 in one day. As a reminder, right? Because that's how we're wired. Us human beings, we tend to forget things. 19 realized volatility, that's where we were at the peak. So that was measured. So obviously, as a reminder, realized volatility is always measured in the past, right? It's what has happened over the last 30 days. So you had 19 when you were early April, which means the entire month of March. So this is the entire month of March. As a reminder, the market got a little bit crazy on the implied side of things, and for good reason. Because again, you had Iran that came. I mean, some people, I wrote, it's crazy because I wrote today that it came as a surprise, and people are always coming and arguing with me saying like, oh, well, how can you say it came as a surprise when, the odds on Polymarket were high and we were talking about this, so it didn't exactly come up as a surprise. And I agree, it didn't come up as a surprise, but yes, it did come as a surprise. Like nobody really expected um, Iran to retaliate, that stuff to go for so long. Then at some point, you can even argue that the real reaction is more driven by as much by the war, but also what's happening on oil prices. I don't think anybody really expected Hormuz to be closed for almost 2 months this year. You can argue with me in DMs as much as you as you want, but you know, my game is more talking numbers. But if I have to put numbers of how many people are betting on Hormuz closed for 2 months this year, I think that number is pretty low. So anyway, all of that to say that to to go back to a point where over the next 4 weeks you're going to see 18 and 19, you will need a serious catalyst. And now Iran cannot be one. I mean, it can still be one, obviously. That would mean World War III or something really crazy and insane. But it can't be Hormuz is closed for another 4 weeks because we're used to that. Um, if I'm being very cynical and rational, I don't even think that US bombing Iran again is going to bring us back to 19. I'm not saying the market will stay quiet, but 19 in realized vol for US bombing Iran again, I think it's fairly expected. Let's see what happens. Um, and ultimately, this is what transpire in all of those like term structure, right? However you want to look at it. That's a very neat and healthy contango. If you look at fixed vol, if you look at forward vol, it's a pretty healthy contango as well. There's no clear um, event risk. Market is pretty much saying, yeah, like obviously something can happen if you look further in time compared to here. But yeah, like okay, you have maybe here really if you squint really hard, but that's not what can realistically speaking called event risk or market being tensed or um tension being in the air or whatever. So it's a tough game to play when you have such a strong disconnect in some way between the level of agitation you find in social media. Financial press was weirdly measured and quiet, I would say, over the last 48 hours. But since I don't know what happened, but since Friday at the close, I think people starting to freak. They started to freak out because you had some reports that apparently the Iranian airspace was closed or whatever that was. And then it was all over social media. That's all I could read over the weekend. Um, so yeah, it's a tough situation to be in where you have to decouple how bombarded you are with all of those nuggets of commentaries and opinion and oh yes for sure we're gonna attack for sure we're going to go back at it. To be honest, Trump isn't exactly making it simpler, right? Because he's the first one to always add some oil on the fire. um but then you can, I think your job is to always come back to those numbers and yeah, assess okay, what's the term structure look like, what's the vol surface looks like. Am I gonna get killed here because I've been selling 18, 19 vol at 39 days and realize vol is at 18, is at 11, sorry. Probably not. But again, everybody looks at it the way they want to look at it, right? Like at the end of the day, I respect that some people don't want to trade here. Um, but if you don't want to trade here, if you're uncomfortable trading here, you have to ask yourself the hard question, which is volatility trading really my game? And am I okay to be a little bit schizophrenic and accept that the game is not so much about being super active when vol is here? Because I was not that active here, if you guys remember. But this is where you are really active, and you're not really active here just for the sake of it. You're really active once again because this is what you trade. You trade the gap between these things. Now, we add an element of probability into what we do, right? Um, we like to compute the probability to see if the number you sell here, so eventually 18, what's the likelihood to see it being above or below realized volatility over the next 30 days? That's really the game that you play, right? Like you can't know in advance. You only know that here volatility over realized volatility over the last 39 days. So those numbers are perfectly aligned. So here you have realized volatility over the last 37 days, 39 days. That was about 10, 11%, but you don't know what it's going to be over the next 39 days. All you know is you can sell 18 right now. So the question you need to ask yourself is what's the likelihood to see 18 being surpassed by realized volatility over the next 39 days for the entirety of the VAR swap that expire in 39 days, so probably June 30th, I would say. Um, yeah, so that's the question we try to answer with math. Obviously, here at the moment, SPY is not at the top of our probabilities. There are some stuff that are there are some situations that are definitely more worth paying a look at. But I think it's still 61%. You will still see me being active in SPY despite a 60%. For the main reason that SPY is, don't want to say that it's a special situation, but in some way it is. It is the index that represents the entirety of the US economy. It's not targeting one specific sector. It doesn't really have idiosyncratic risk the same way that a stock can have it, but even the sector, right? If tomorrow you have a lot of discussions around financials, for instance, the way that we used to have them, by the way, in February, March, around potential credit crisis or whatever, like financials are going to be affected, but SPY doesn't necessarily going to be affected in its all. So yeah, I often say if you see 66% here, you're fine. Just go trade it. I think SPY 60%. Personally, I trade SPY. I've been trading SPY really actively over the last year, probably more than usual. Um, and again, it's more because by experience, when uh, when stuff like this happen, like Liberation Day last year, not this year, um, people stay burned, and I coined that term today in the newsletter. You have what's baked in these days, a certain level of Trump risk premium, where people aren't going to take the risk as long as Trump is in power. They know that something crazy can happen in fairly short term, and they will always go buy some options because something can happen. And that's very different from the kind of mood and mindset you had uh, post regional bank crises, where multiple times we went to very low VIX numbers, 12, something like this. Like you can argue that things aren't that different, but they are very different, and the only big difference is really well, obviously geopolitics is very different, right? We're not gonna say that that's not different. But you know these days that something can always happen at any moment, any minute. And that's what explained those 2, 3, 4 points difference between okay, VIX 12 and VIX 16. In the mind of most people, it's the same, and they will just say, "Oh, VIX is just really low," but really it's not the same. You have enough buying of edges in the market at 16, 17, which is purely associated to that headline risk and Trump, for you to make money consistently selling that stuff. While in situation like this, 1 point VRP, 2 point VRP, 3 point VRP, good luck. That's much harder. And that's also the reason why you don't really see me insist too much on risk reversals yet, right? Like here, I was trading a lot of risk reversals because it's really hard to make money being delta neutral. Stuff drift up all the time. You don't capture enough vol premium, so it's quite painful. But here, yeah, sure, you can do a risk reversal, as I said, but I think skewing your stronghold is probably a better approach for what we're trying to do. And then, yeah, just manage your risk. Don't if you don't want a crazy number of deltas, don't skew them too much, and don't indulge into the um, into the risk reversal either. Now that we've said this, VIX is at 16. Um, so this was super useful having wings. Let me come back to a more reasonable time frame. This was super useful for many of you guys in the group to have wings when we went through this, right? A lot of people felt much more comfortable because wings are bringing liquidity and margin relief when you need them the most. So now is the time where, okay, markets are quiet. You know that there is some headline risk, right? That's the reason, again, the reason why you're being paid is because people are willing to overpay for headline risk. So you don't want to be, well, you don't want to be oblivious of the fact that that's the reason why you're being paid, and therefore you need to reassure the book. I don't think you should come by that here, as we just saw, right? Those ones are quite expensive. Everybody is here, right? Um, I don't think you should buy these ones. They're not cheap enough. We'll see situation. I've seen situation where even at like 5 delta puts, you can get 4, 5, yeah, 4, 5. I've seen 4, 5 points of VRP on the 5 delta put at 0, 1, 2 DTs. I think they're still expensive. You don't have to come here. But in general, the big difference between this one and a 6 months, even if we say 5 delta put, but let's say something more reasonable, 10, 15 delta put, here you're basically exposed to max gamma. You want a big move fast and taking everybody by surprise. And you think that that's not priced in. Here, you're betting more on implied volatility to potentially go up, and um, therefore your book being protected against rising implied volatility. That number may feel high, 26, right? And of course it's high because even at the worst of April, we didn't realize 26, right? Again, like we're selling VRP, but we need to understand exactly how we're buying options to put things into perspective. In August 2024, we didn't even do 26. So of course, those options are expensive, but they're expensive for a reason. Um, the minute the markets will go down, implied vol at 26 here will probably become 32. These options are filled in Vega, and yeah, that will bring the excess liquidity that I've been talking about at the moment where you need it the most. So yes, they're expensive. Theta is not really a problem 6 months out. Um, but if tomorrow there is something happening, yeah, you'll be very happy to have them. And as usual, by both sides, not just the 10 delta put, but also the calls, because everybody's focusing on the tail risk. Oh my God, something happening or whatever. Um, if you make a ratio of how many theses you see explaining that stocks are too high, we should be at 6,000, maybe 5,000, and the number of theses that tells you, well, why not SPY at 8,200 by September. Why not SPY at, let's go crazy, 10,000 by the end of December? Obviously, it's crazy, right? Obviously, everybody can have their opinion and whatever, and it's unlikely, right? But you do some basic math. Basically, SPY 5,000, SPY 10,000. It's almost flip of a coin territory, right? So yeah, like don't just buy the puts, always buy the calls. And when markets drift up, um, once again, these ones, they're going to bring you the convexity you want at the right moment, not necessarily because Vegas is going to go up, but just purely because our time passes and we drift higher. And the nice thing of convexity is that it accelerates and pays you a little bit more. But also, yeah, you don't have to, let's say that you've been selling strongholds here. You don't have to think much of your call side because all of a sudden you're you're hedged. Um, so it was a little bit more on portfolio constructions kind of and portfolio management in that situation where yeah you have I think you have a strong decoupling right now between um, the temperature on socials that are a big part of the job now in 2026. I don't want to negate them and even pretend that they don't exist. I personally solve that problem by just avoiding them as much as possible. But yeah, they're part of the job, and it's very easy to get caught into all of those theories and then end up taking reckless actions when yeah, I mean, what exactly is the problem, right? I'm happy again to debate about a lot of a lot of those theories, but right now at VIX 16, 17, the market doesn't give a lot of credence to these theories, and even if it does, the risk is just not there. So yeah, let's just keep doing what we're doing. If you guys have questions, I'm happy to answer.
I have one. I don't know, maybe it's a more philosophical question, but what's your kind of take on monetizing those tail options that you buy? Because it's very personal, of course, how you go about that, but I don't know if you have some sort of wisdom on that front.
So there's no real wisdom, and it doesn't have. In fact, it shouldn't be philosophical. It should always become a question of um, what risk you have in your book. So these days, I've been selling this week, actually, the last week, I've been selling quite a few of my calls that expire in August um, because they become Delta 40, they're now in that region, right? And so you bought them nicely when they were quite cheap, Delta 5, 10. The market is at what, 7,500 now. So yeah, like I had to sell 7,700 and 7,800, I think, end of last week. Not because it's too green. The fact that it's too green is only a consequence of, well, if I keep them, I have too many deltas in my book, and they start to arrive at the point where it costs me theta to keep them. 90 days, you're still okay, right? You're not gonna feel it yet too much, especially I'm quite loaded in that region, so I don't feel it too much. But instead of just selling more stuff here, which means increasing your gamma risk, if you come sell stuff closer to the money, yeah, you mechanically increase your gamma risk. And I don't want to increase my gamma risk. and I want to decrease the amount of money I lose because of time, well then, and I have too much deltas, then there's not a lot of stuff you can do. The next logical action and step becomes naturally, well, what is costing me time? What is costing me, I mean, giving me too much delta exposure? And what is also giving me too much gamma, right? Because much closer to the money. So obviously the gamma here, even if it's close to the money, is much smaller than the gamma around here. It's probably comparable actually. I don't know the exact numbers, but yeah, it's even if it's comparable, so this one become the it becomes really the target of your trimming. It's green, it becomes a bit of a risk directionally. It becomes a burden time-wise. So it's just time to trim it off. Um, so in fact, yeah, I don't think it's philosophical at all. It's like, okay, what risk do I want in the book? My off-risk limit, and therefore, what are the options I need to keep, or I need to buy, or I need to get rid of in the book so that the risk comes back in line. It's in fact that's probably one part that should be really mechanical, to speak like the tasty trade gang. I don't think you should necessarily be mechanical in coming here and selling 30 days, although these days in SPY, yes, just be mechanical. But the minute you see that you have too much deltas here, um, the temptation will be big to come and say, oh, well, I have too much deltas. Maybe I should sell those. Yes, but if you sell those here, sure, you solve your delta problem. You're kind of solving your theta problem, but you're creating yourself a max gamma problem. So really, you shouldn't do that. It's not, it doesn't tick all the boxes. This one here is is ticking all the boxes. Just get rid of the wicks. Um, and then when do you buy wings? I personally buy wings pretty much every week in small quantities, very small quantities, always somewhere 5 months to 12 months out. I don't think it's necessarily. I actually like. I go further than 12 months, but in individual stocks where I'm gonna go and buy sometimes, yeah, 2 years out. I think I have a bunch of stuff that expired January 28, I think. A lot of like tech stuff, whatever. Um, yeah, and those same idea once in a while. I think I had to trim isn't it VIX? WIX. Yeah, they lost something crazy. Like in one day, they lost something like, I want to say that was last week or the week before that. I must have lost something like 30% or something like this. So now it's the same idea, right? It's not like, so obviously it's the same idea in the sense you want to look at it, you want to look at the risk at your book level, but then if you have um, then you can compartmentalize the book in different ways and saying, okay, well, maybe I want to look at the risk metrics for all of SPY together. It kind of makes sense. And then maybe I also have some risk metrics regarding tails that I'm buying specifically in individual names. And you can have risk metrics around at that specific level and that specific line. And therefore, when VIX is losing, I'm only saying VIX by the way, because but that would work for any other tail that lose 20, 30% in one day. All of a sudden, the risk metric that you have for that specific part of the book is out of whack. Same idea, right? Like all of a sudden, you're really much more short. I bought them. They were like there were nothing, right? Like I mean, I know I had put 50 June 28th, something like this. I had quite a few. I think there's some, even a weird one, 37 and a half. I think for some reason I have 37 and a half. I don't know why I have that number in mind, but it doesn't really matter. All of a sudden you had maybe one delta put, and now it becomes 10, 15, or 20 delta put. You are much more short than you were 1 or 2 weeks ago. So you have maybe VIX and 10 other position. The amount of short delta that you have right now is much higher. You have gamma is not really a problem in those situations, but a little bit. But what can become a problem often is more vega. You have much more vega in your book because you went from delta 5 to delta 15. Do you want all that risk in that section of the book? Probably not. And in that case, trim a little bit. But you need to start by understanding and having a granular understanding of what's the what's the amount of risk I'm willing to have in the book in its entirety, and then specific subsections or sub-strategies or sublines that you might be monitoring. That's my answer. I think it's an answer that works. At least it works for me. Although this is one of the expressions I hate the most in retail trading. It should work for most people. Just have an idea of the risk you want and manage the risk you want.
Oh yeah, makes sense.
Cool. All right, guys. Thanks for showing up. Have a good short week, and I see you all in the Discord.
Thanks,
See you.
Alex. Thanks, guys.